Well, banks, both big and small, are up against rising costs as they shake off the remnants of March's crisis. With large lenders like Citi, JP Morgan, and Wells Fargo set to kick off earnings season on Friday, what does the year ahead look like for the sector? With more, we're joined by Polo Rocha, who is American Banker Reporter. Good to see you this morning. So as we look at these banks, the conventional wisdom had been that the larger banks would be okay, that they were more insulated from a slowdown in lending, et cetera. How is that going to play out, and is it going to play out as we start to hear from them?
Yeah, I think that largely holds up. I think the bigger banks, particularly the retail-focused one, JP Morgan, Wells Fargo, Bank of America, they have a pretty big diversified business. I think other banks that are maybe more concentrated on Wall Street deal-making, kind of helping companies finance merger activities, there's been kind of a big slowdown in activity there due to just general economic uncertainty. So those banks might be hit a little bit harder. But I think, the big banks, JP Morgan, Wells Fargo, they should do just fine. I think the more interesting part of earnings will come later on next week and the week after when some of the regional banks start reporting.
The interesting thing was to do a kind of Command F or Control F, depending upon what type of PC you're using at home, on deposits when we were combing through some of the earnings call transcripts and even the earnings reports themselves that dropped from the largest banks and even regional banks last quarter. This quarter, if there's anything that you would be kind of laser focused on, what would that be? Would you be looking across investment banking or where some of the kind of corporate client banking stands? Where would you be laser focused?
Well, I think everyone's kind of looking most closely at deposits. I think, with the failures of Silicon Valley Bank, Signature Bank, the kind of big, panic that, mini crisis that we saw earlier this spring, those kind of worries have kind of faded. But, should any banks kind of report any big surprise on deposits, maybe there'll be some more talk of that. But I think largely speaking, things have kind of stabilized. But I think the bigger problem now is that, banks are kind of facing a slow grind of profitability challenges, deposits, in order to keep those deposits, right? Because deposits are so important for the banking industry. Banks are having to pay their depositors more. Corporate clients want more interest for the cash that they have at their bank. Consumer clients, they want higher rates on certificates of deposit, on their savings. And banks are really having to maintain these deposits and paying up to do so. So some of the banks that kind of faced more challenges but are still around, they're paying out a little bit more, and that's kind of driving, or a lot more, and that's kind of driving competition for deposits across the industry. And that's really the kind of big driver. Is not only the level of deposits, but if you are keeping deposits, how much is that going to cost you for the next year?
Well, and when we talk about profitability, we also have to talk about regulation, right? We heard from Michael Barr, the vice chair of the Fed, who oversees supervision of the banks, yesterday, talking about the need to increase capital requirements or increase the threshold under which, I should say, lower the threshold under which some of these banks might be under some of these capital requirements. Do we expect to hear much from the banks themselves, though, during this earnings season? Like, are analysts and investors going to start to pressure them to get some hard numbers on the effects that all of this could have?
I think so. I think, we've seen some hints of what was coming before. Yesterday's speech from Michael Barr, the Fed's vice chair of supervision, really kind of added some more details on what we're going to see. There's still a lot to be fleshed out, but, banks have been talking for the last several weeks and months, especially after Silicon Valley Bank's failure, that they don't want regulators to take that hard of a line, because that might have ramifications. It might lead to a cutback in lending and even more caution from banks. So, I think certainly capital requirements seem to go up, or are going to go up for banks. That's always going to be the case for the big banks, who are always maybe going to be subject to tougher rules from the current administration. But I think, the failure of Silicon Valley Bank has kind of prompted a spread for those rules to apply to regional banks that have, more than 100 billion in assets. They're not mega banks, they're not JP Morgan, they're not Wells Fargo, but they have a kind of big presence in their regions. Those banks are going to face just a higher cost of doing business. They're going to have to have a like a bigger piggy bank in case there's a recession and they need to protect their their books. They're going to have to set aside more money for a rainy day, and that's just going to lead to fewer loans, presumably. Not that much. I think the Fed says it'll be modest, but it certainly will weigh on them in the future. And I think investors are aware of that, and I think that's one of the reasons why bank stocks have they've bounced back, but not so much.